Let me tell you something that might sound provocative. Most real investors, even the successful ones, are playing the wrong game. And I don't want to say that to sound smart. I say that because I've seen it up close. Entrepreneurs with seven-figure exits, doctors who own half their block, even family offices managing generational wealth. They're all in the game, but not all of them are winning. Why? Because they're playing on the wrong field, chasing yields instead of building capital, confusing activity for strategy, and maybe most dangerously, copying institutional moves without understanding the institutional mindset. If that feels like a punch to the gut, good. That means that this conversation is for you. Here's the truth. The real estate world sells a seductive story. Passive income, tax advantages, appreciation, and cash flow. And most investors fall for it. They follow the scripts, buy a duplex, flip a home, add short-term rentals, scale to syndications. But somewhere between the spreadsheets and the strategy calls, they realize this isn't the game they thought they were playing. Their time is gone, their returns are underwhelming, their portfolios are fragile, and what started as a wealth builder becomes a second job, a trap. I know because I was almost that guy. After I exited my first company, I did what every textbook says to do. I started allocating capital, mostly into real estate, looking for yield, looking for leverage. But what I quickly realized was that I approached real estate like an operator. I'd never grow like an allocator. And that shift from operator to allocator, from player to architect, that's what changed everything. That's when I started building capital instead of just chasing cash flow. That's when Infinity 9 was born. And that's what we're going to go back today. In this video, I'm going to walk you through why most real estate investors are trapped in the wrong game, even without knowing it, the three core shifts that separate elite capital allocators from everyone else, and how you can adopt a family office mindset even if you're just getting started. Because the truth is, you don't need 100 doors. You don't need to syndicate your soul. You need clarity, structure, and the discipline to say no to the good deals, so you can say yes to the great ones. Let's start by looking at the first trap. Let's start here. What if your best performing property is actually your worst investment? Because I've seen it happen many times. It starts with a spreadsheet that looks beautiful. 7% cash on cash, 18% IRR, equity multiple over 2x. You feel like a genius. Maybe your friends ask you for your broker's number. Maybe you've even gone on bigger parkets sharing your framework. But then something strange happens. 2 years go by, you're busier than expected, the returns didn't compound, the value hasn't appreciated like the sponsor promised. You can't exit without friction, and when you zoom out, you're tired, illiquid, and no closer to financial freedom than you when first started. That's what I call the return illusion. Yield is not wealth. Cash flow feels good, sure. It's visible, it's tangible, it scratches that dopamine itch. But cash flow without strategy, that's just a side hustle with better branding. Wealth. Real wealth is built by stacking asymmetric bets, optimizing for after-tax outcomes, and structuring capital in a way that compounds intelligently over time. Let me give you a simple analogy. Imagine two friends. One friend buys 5 small multifamily buildings. He self-managed, reinvests rent income, and celebrates his 9% cash-on-cash return. The other friend invests in a well-structured preferred equity deal, collects modest coupons and waits. On paper, the first deal looks smarter. But zoom out 5 years, the second friend's deal refinances. He gets 80% of his capital out, tax-free, while still holding equity upside. He reinvests that capital twice, while the first friend is still fixing the second roof. By year 6, the second friend has tripled his money and his capital, not just because he worked harder, but he played in a completely different game. That's the game most investors don't see. Let me be blunt. Most investors are obsessed with income because they don't understand allocation. They don't trust their capital to do the work without their involvement. But here's what elite investors understand. Capital is a worker. And it's a job that doesn't just show up. It's a job to replicate itself. quietly, repeatedly, tax efficiently. And that only happens when you think like an allocator, not like an operator. You're not buying deals, you're assembling a portfolio. You're not optimizing for yield, you're optimizing for velocity adjusted, risk weighted, tax defensible return on capital. That's not just finance talk, that's how real wealth is built. I'll give you a quick example from our world at Infinity 9. We once passed on a bulletproof multifamily deal in Austin. Everyone wanted in, the cap rate was tight, but the growth story made it feel like a no-brainer. But our underwriting, and I mean real underwriting, not just spreadsheet manipulation, told a different story. We saw compression risk. We saw optimistic lease-up timeline. We saw a sponsor we respected, but who had never executed this type of strategy in a high interest rate environment. So we walked, and that deal is now underperforming pretty hard. Cash flow is frozen, LPs are angry, the sponsor's upside has evaporated, and what did we do instead? We deployed capital into a boring preferred equity position in a low drama retail development. 8% cash pay, 65% LTV, protected by a personal guarantee. We exited 4 months within our annualized IRR north of 60%. Sometimes boring is beautiful. So what's the takeaway? If you're measuring success by annual yield, you're not building capital. You're playing checkers on a chessboard. The real game is about structure, optionality, and asymmetric upside. What I want you to ask yourself is this: can this deal compound for me? Can I exit without friction? Is my downside protected? And does this move me closer to freedom or just deeper into the game? Because I promise you, once you start asking the right questions, the deals start to look very different. Let's go even deeper, because even the investors who understand this, they often fall into the second trap. They try to copy institutional playbook without the institutional mindset, and that's where everything breaks down. Let's unpack that next. There's something strange that happens when smart people get a little capital and a little momentum. They start acting like institutions. But here's the problem: you're not Blackstone. And you shouldn't try to be. I get it, the temptation is real. You see the reports, you hear the podcast, you read that some mega fund just raised billions of dollars and bought up 40% of the market in some zip code you've never even heard of. And that logic goes, if it's good for them, it must be good enough for me. So you start mimicking. You try to scale fast. You chase capital stacks that don't fit your risk profile. You model your acquisitions after REITs, and you tell yourself the secret is more leverage, more LPs, more doors. But what you're really doing is copying surface without structure. You're imitating outcomes, not infrastructure. And that's how people get hurt. Let me explain what I mean. Institutions, the real ones, play a different game because they have different foundation. They have teams of analysts watching one submarket. They have internal legal and tax counsel who design every deal down to the comma. And they have a multi-decade funding timeline. They raise capital with different expectations, different pressures, and a cost of failure. So when they buy a forecap, they're doing it with a 30-year view, with sovereign wealth capital behind them, and with the risk hedges you don't even see. But most individual investors, they're doing it with a bridge loan, a player, a partner that they met on Zoom. That's not the same game. That's not even the same sport. Here's where I see people go wrong. They confuse sophistication with complexity. They think, if I make it look institutional, I'll attract institutional returns. So they layer unnecessary complexity into their deals. They over-engineer capital stacks. They raise from people they shouldn't be raising from. And they take risks their own families wouldn't touch. But sophistication isn't about more. It's about precision. It's about knowing exactly what you're underwriting, exactly why it fits in your portfolio, and exactly what downside protection do you have against it. Let me tell you a story. We once looked at a deal where a sponsor proudly told us we've got modeled at 12 IRR scenarios and created a convertible mezzanine loan structured to optimize upside. Sounds super impressive, but when we asked, have you actually looked to this capital stack before? Silence. Turns out they hadn't, and they didn't fully understand the tax consequences of the conversion clause they wrote into the term sheet. This is what happens when people copy institutional wrappers without institutional wisdom. It's financial cosplay, and it's dangerous. Now contrast that with what we do at Infinity 9. We don't try to look like a big firm. We act like a small one. Our edge isn't size, it's agility. Our advantage is a brand name, it's discipline. We don't need 100 deals, we need 5 that are surgically structured, stress tested, and designed to work across market cycles. We deploy into best-in-class sponsor, structure-first position, often preferred equity or structured JVs, where we can shape outcomes instead of hoping for them. And we stay small on purpose because agility beats scale. When you understand the field you're playing on. You know what the best allocators I've met have in common? They ignore 90% of what the market is doing. They aren't rushing to seen as smart. They're obsessed with downside. They love boring structures with beautiful risk-reward profiles. They don't try to be Blackstone. They try to be invisible and quietly compound wealth without drama. So here's my challenge to you. Before you build a fund, before you raise from LPs, before you pitch yourself as the next real estate entrepreneur, ask yourself, am I solving for ego or for outcome? Do I understand the structure or am I mimicking one? Would I do this deal with my family's capital, not just with my investor deck? Because when you stop chasing scale and start optimizing for clarity, structure, and strategy, that's when the game changes. Now we've talked about the return illusion and what the dangers of copying institutional models blindly. But there's still one more reason most investors are playing the wrong game. They build portfolios that make them feel busy instead of free. Let's talk about that next. Let's shift gears, because even after we clear up the return illusion, even after we stop copying institutional models, there's still one trap that catches almost everyone, especially ambitious people. It's the trap of busyness masquerading as success. Let me ask you this. Is your real estate portfolio actually making your life better, or is it just giving you more things to manage? Here's a pattern I've seen over and over. Someone starts investing in real estate because they want freedom, financial freedom, geographic freedom, time freedom. But instead of building a portfolio designed around their life, they build a second job. They get caught in this momentum loop, adding properties, joining masterminds, tracking KPIs, underwriting deals late at night. Suddenly, they're running a mini real estate business, but they never meant to. And here's the kicker. Even when it works on paper, it often fails in practice because they built a machine that needs them to keep feeding it. It's not freedom, it's just familiar. At Infinity 9, we define freedom differently. To us, a good portfolio isn't impressive, it's invisible. You don't need your name on 12 LLCs. You need peace of mind. You need clarity. You need structured positions that let you opt out, not just buy in. Let me walk you through a real example with the details anonymized, of course. A few years ago, we had a prospective investor. Let's call him Luis. He ran multiple businesses across Latin America. He was super smart, successful, charismatic, and a little tired. He came to us with what looked like a beautiful portfolio. He had 18 rental properties across 3 countries, 2 flips in progress, 3 LP positions in syndications, and a small real estate fund he had started with his friends. I asked him one question. Which of these actually makes your life easier? He laughed and said none of them. They all give me more to do. So I helped him do something radical. We unwounded that noise, we helped him exit from those distractions, and we reinvested into 5 strategic positions, a mix of preferred equity and structured debt that aligned with his goals, which were predictable income. He had zero operational involvement, true downside protection, and 12 months later, he wasn't just earning more, he was calmer, he had his time back, and he had clarity. That's what I mean when I say build a portfolio that serves your life. Because here's the mistake most people think. They think investing means saying yes to everything that looks like a deal. But what elite capital allocators do is spend more time saying no than saying yes. They focus not on owning more, but owning better. So how do you do that? Let me give you a simple framework. We call it the three freedoms test. Before saying yes to any investment, ask, does this give me time freedom? If it works, does it give me more time or does it demand more time? Does this give me emotional freedom? Will I sleep better knowing I'm in this deal or worse? Does this give me financial freedom or just financial movement? Am I building capital or just cash flow? If the answer isn't yes to all, at least two of them, walk away. Because I promise there is always another deal. But there's only one you. You don't need 50 doors to be free. You need clarity, you need a framework, and you need the courage to say, just because I can doesn't mean I should. And that's where I want to leave you today. Not just with a list of tactics, but with a new lens. Because most real estate investors, they're not failing because they're lazy or uninformed. They're failing because they never stop to ask, what game am I playing? Who set these rules? And do I even want what winning looks like? The real game is not about owning more buildings. It's about building more life. And that takes a different kind of strategy, a different kind of mindset, and a different kind of community. I didn't start out with frameworks. There was a moment right after I exited my first company where I felt both excited and completely lost. I had liquidity, sure, but I didn't have clarity. And I made the mistake many of you probably made or will. I thought being busy meant I was making progress. I chased deals. I tried to underwrite everything myself. I said yes to people I barely knew because they sounded confident. And for a while, it worked until it didn't. There was one deal, I still think about it, the returns looked phenomenal. I was pitched as a value add multifamily project in the fast growing Sunbelt city. The sponsor had charm, the deck looked polished, the numbers, they were too good to ignore. But my gut was uneasy. Not because the deal was bad on paper, it was it was fine, but because I couldn't clearly answer one question. What problem does this solve for me? I invested anyway, ego overrode instinct, and 6 months later, the sponsor missed their projections. A year in, the refinance fell through. 2 years in, we were in damage control mode. And here's the part that stung the most. Even if the deal had worked, it wouldn't have made my life better. It wouldn't just padded an already messy spreadsheet. That was the moment I started rethinking everything. Not just about investing, but what I wanted for my capital, from my time, and from my legacy. I built Infinity 9 not because I had all the answers, but because I knew the questions I should have been asking. I knew there had to be a better way to allocate capital, to build without burning out, to create portfolios that actually serve the people who built them. So I built the frameworks I'd wish I had when I surrounded myself with the thinkers who challenged me. I replaced the noise with clarity, and I stopped trying to look impressive and started focusing on what actually mattered. If any of this hit home, if you felt the frustration of doing the right things but not getting the outcomes you hope for, let me say this clearly. You are not alone. You're not behind, and you're just ready to play the game better. So whether you keep doing it on your own or whether you eventually want a thought partner like us, please promise me one thing. Don't chase deals. Build capital, build clarity, and build a life that doesn't need explaining. Because real wealth, it's not measured in square footage. It's measured in freedom. So let's land this plane. We've covered a lot, and maybe your head's spinning a little. Or maybe for the first time things actually feel clear. Either way, good. That means you're waking up to the real game. Let's recap. Most real estate investors are trapped in the return illusion, chasing yield while eroding wealth. Many are copying institutional models without the infrastructure or the incentives that make those strategies work. And nearly all are building busy portfolios that demand more from their life instead of buying it back. But if you walk away with one thing from this video, let it be this. The game isn't about stacking properties. It's about stacking decisions, discipline, structured, compounding decisions that build capital, not just ego. Here's the part no one says out loud. You do not have to do it all. You don't have to be the operator, the analyst, the fundraiser, the manager, the exit strategist. You just have to think like an allocator, ask better questions, slow down long enough to design the outcomes you actually want. Because freedom isn't the result of volume, it's the result of clarity. Now, if someone who's either already investing in real estate and feeling stuck in the weeds, or maybe you've built capital from your business and career and want to deploy it wisely, then I want to give you something that could help. It's a short book I wrote called The Real Estate Funds Made Simple. It breaks down how real estate funds actually work, not the pitch deck version, but the real mechanics. How capital stacks are structured, what projections should you negotiate, and what elite investors look for before writing their first check. It's not fluffy, it's not salesy. It's just a resource I wish I had before I even raised capital or joined a fund. So if you want the book, just follow the link in the description or comment on this video below and I'll send it to you. It's completely free. It's my gift to you. Why? Because when I exited my company, nobody handed me a playbook. So now I wrote it and I want to give it to you. Let's make sure your capital plays the same game.